time down there, and my undergraduate school was Clarkson University.
New Jersey. I'm a human resources analyst for American International Group in Manhattan, and I went to Lehigh University.
Yeah.
My name is Bill Bennett. I went to Duke, graduated in '92. I now live and work in New York City, doing investment banking for a firm called Foxbit Kelton. Specializing in banks and insurance companies.
My name is David Ashheim. I went to the University of Rochester. I used to live in New York. I now live in Boston. Formerly, I traded commodities on the Commodities Exchange in New York. Now I trade foreign currency, helping small businesses.
Okay. So that's assignment 3, and I will hand back both 2 and 3 on Thursday. Okay. There's 2 lecture notes in the back. Let's see. On Thursday also, today what I want to do is to go through capital structure and dividend policy and begin on project evaluation. I want to finish project evaluation on Thursday. I'll also hand out the solutions to the final exam that was given last year. So I'll also go through the solutions to that exam on Thursday. Yes?
Are you going to provide solutions on concept 4 as well?
Oh, yes, absolutely. So I'll hand out 2 things. So the solutions to assignment 4 and the solutions to last year's final. Those will be the last 2 handouts. Also, talk very briefly about perhaps one of the most important things in international finance, and that's the idea of what's called covered interest parity. It's like the minimum that you need to know in terms of moving to second-year courses. So I'll talk about that. Any other questions? What I want to talk about just briefly before we begin, I know you're involved in selecting courses for next term, and I understand today's the first day to do that, right? So if the system worked, it would be and the last day isn't until January, but this is maybe a good time to do it. Let me try to give you know this is available, right?
Who's that picture?
Get rid of that picture.
Keep saying.
I need somebody to help me with the pictures. Okay, so this is the finance homepage, and let's see, where's the draft schedule? So you people, I assume, have exempted some courses. If you're not a finance specialist, okay, so and that's maybe half the people here, and we took the survey, didn't we? That's definitely not, I already told you, the average of the midterm was in the 5% tail all the years up top, so it's not good. So maybe it's more than 50%. Okay, so if you're not a finance specialist, and let's say you're a marketing specialist or operations, then you need to take corporate finance 351. And 90% of the students take that course, and the other 10% make the mistake of not taking it. They regret it later on when they have to get the book and try to learn it on their own 3 years after they graduate. So you should plan to take that course. However, I would probably recommend you take it in spring 2 or fall 1. Okay? Probably not spring 1. And the reason is that it's the same person teaching all 3. It's nothing to do with that. But it's just that I think that probably this is going to be loaded up by the people that are specializing in things. Okay, so it's going to be, when you take the survey in the class, it's going to be like 95% of them are specialists in things. So it just might be a little easier to take it spring 2 or fall 1. but definitely take it. And the other possibility, the other interesting course that you might want to take is the International Corporate Finance. So even if you're not a finance specialist, this is a very good and challenging course that it's actually one of the very few schools that offer an international corporate finance course. Everybody offers an international investments, but not an international corporate finance course. Yes?
I just have a question. If you wanted to specialize in finance, so you wanted to take finance next term, and you can't take corporate, what about taking international corporate?
No. Okay, well, we haven't got to the finance specialist yet.
Okay.
So for
I'll
the
just
non-finance
reply.
specialist, take corporate, either term 4 or term 1 in the fall. And if you want to take a third finance course, then I'd probably recommend the international corporate course.
What exactly
Yeah, I can't go through all the syllabi, but they're all linked on the homepage. So you can go and take a look at the lecture tiles. So everything's available. But it's a good international course. So if you're a finance specialist, then I would take corporate next term. And I'm assuming you've got a couple of electives, so I'd probably take investment in term 4. And let me give you some advanced information. It's not totally settled yet, but I talked to Doug Breeden on Friday, and he's agreed in principle to teach a financial institutions course in term 4. It's not on the schedule. It doesn't even have a number. But when he says he wants to teach, he'll definitely teach. And he hasn't taught here in 3 or 4 years, but probably the reputation still is around. This is a course to take. So you definitely want to free up a space for it and take that in term 4. Okay?
Term 4 this year, term 4 next year?
Going this year. If he teaches like every 3 years, then you're not going to have a chance to take it next year. So when he offers you his cake, it turns out that also this course is remarkably good preparation for his course. Because you notice in the acknowledgments, all those web notes, that his name is often there. And my course is modeled, and actually a lot of materials are lifted from his lecture notes when he taught his course. So I would recommend that as a good strategy. And then, next year, it's pretty clear there's lots of interesting courses. Restructuring, wait until second year. Okay, I think it's a mistake to take this immediately. It's just so much better of a course once you've had the derivatives course and the advanced corporate finance course. Okay, this restructuring course is taught by Michael Bradley, and he's definitely going to be here next year. It's a recent acquisition, and he is building a great course that he's taught at Michigan. He's trying to get one of the pretty good law professors involved in this too. So it's going to be a very good course. It's going to be open now to law students and business school students. But I think it's more like a capstone course. So if you're in second year as a specialist, you almost have to take derivatives. Even if you're going to do corporate finance, you need the derivatives, and it's evidenced by 3 sectors that were full this year. So it's the second most popular course in finance. And if you're doing more corporate finance, you can avoid the money in capital markets. If you're doing more investment finance, then you should take the money in capital markets. Advanced corporate is highly recommended. There's 2 specialty courses, international investments and advanced derivatives. I teach the international investments. Steve Gray teaches advanced derivatives. Those are very advanced courses and difficult as a result. They don't get a large enrollment, but they're also unique courses to our school. And as I said, the last term you should take restructuring. There's also, we now have somebody staffing tax planning. And this is a course that's a very good course at a number of schools like Stanford, but we've never had anybody that could teach it. And now we've got somebody in accounting, Steve Hutter, that can teach this course. So that's real good. The other courses that you should consider are Statement analysis, which I believe that's offered next term. You can probably take that even in your first year. Okay. I don't know what the prerequisites are, but at least one course in finance is a prerequisite. So you could take that, even though it'd probably be better to take it along with corporate finance. Yes.
Is it worth taking it for CPA?
Oh, absolutely. It's what this has to do with is not, like doing a statement, but looking behind the statement, see how people manipulate statements, and then using the statement information to come up with an opinion on the firm. Things that the standard CPA, it goes well beyond that. It's a course that's a very good course.
Can I ask a follow up on that?
Yeah.
I mean, not what you did auditing was, I mean,
Yeah.
physically putting together, like we're looking at it, we still think that it's.
Absolutely, yeah. It has nothing to do with that. Yeah. So, it should still be a very good course. So, it's the most finance-oriented accounting course available. It's like, you've got all these firm attributes. Like what I do this kind of indirectly. I treat all these ratios as attributes. So I go through the financial statement and come up with a set of attributes based upon the statements, and then I use that in stock selection. And you don't do that in audit. Right? So it's like how to use these numbers, how to detect manipulation. That's not obvious that you do that. You might have some ideas, given that you've done audit, but to actually systematically test for it is something that's quite unique. There was another question?
Yeah, how do we stay informed about Doug Reed?
Idiot?
Is Doug Reed teaching that course? How do we keep abreast of whether he's...
I'll post something on it, okay? But these people, if you start asking them questions, they're not going to know in it, because that course doesn't have any number.
Right.
But so I just wanted to tell you because I'd say with 0.99 probability it will be offered, was not negotiated yet. They're in the midst of negotiating. And, it means that we have to adhere to his schedule, which could mean some double lectures, 5-hour lectures, but it's worth it. You walk out of a 5-hour lecture with him, and everything's going to be fresh. He's so good. It's a great lecture. Yeah.
Just say a little bit more about the advisability of taking financial statement analysis this coming quarter.
So if you have 2 elective, let's say you wanted to take, then I might be tempted to do corporate and save international corporate for second year. But in the second year, in that term, you have to do international corporate in advanced derivatives if that is your interest. It's a course that I think everybody should take. We filled 3 sections last year. There was somebody different teaching last year. So maybe this person teaching doesn't have the reputation that the person last year did, so I'm not sure how many sections will be filled. But it's an extremely valuable course. The most valuable accounting course.
And would it kill you if you weren't taking corporate at the same time, like you only had 1 elective?
Well, if you only have 1 elective, then take Corp Fin. I think that's smart. Any other questions about this? Okay, well, let's talk about capital structures. So this is a corporate finance style topic. We're talking about here, dividend policy and capital structure. I'm not going to talk about it in great detail. There's more detail in the lecture notes than I'm going to go through. Basically going to give you the intuition, and we can walk away with that, and they can devote, a couple of lectures in corporate finance to each of these topics. I think that you have to have some introduction to this because it's such an important topic. On the other hand, it's probably not something that you're going to have a major impact on, at least initially when you get out. Setting the firm's dividend policy or setting the firm's capital structure. It's usually decided at the very highest level of the firm. But nevertheless, that doesn't mean that we shouldn't try to understand exactly what's going on. So everybody knows what dividends are. They're cash payments that are made. And there's different types. But the question is, like, how do firms set dividend policy? And there's this really famous study done by Lintner, and he's the co-inventor of the capital asset pricing model. He did this before the capital asset pricing model. And it's kind of an unusual style of economic modeling compared to today. He actually went out to industry and just asked the CEOs point blank, how do you set your dividend policy? And so he did this survey of people to get an idea of how it works. And one thing that he found was that it's not the case that a firm might have a policy of like 40% of earnings are paid out as dividends. It's not the case that that's implemented, like if you make $1 in earnings, 40 cents is paid out, the next year $2, that means 80 cents is paid out. It's not implemented like that. The firms might have a target payout ratio, and they can vary from that target. So it might be that you have a big jump in earnings in 1 year, and the dividend doesn't adjust. It could be because it's a transitory jump in earnings. Or it might be you have a really bad year and your dividend isn't cut to zero. Okay, so this is what he learned, and he actually found that, and he tried to actually model this mathematically. He found that this formula here, where the dividend at period 1 is the target ratio times the earnings per share in period 1, was not the model that people used. So he proposed a so-called partial adjustment model, which basically takes a target ratio where you try to model the change in the dividend is the target ratio times the earnings per share minus the previous dividend. And what this does is that it allows for the possibility that if the earnings go up dramatically, that the dividend is going to slowly adjust up. And part of the intuition here is that people don't like to cut dividends. Firms don't like to cut dividends. So even though it might look really good in terms of the earnings in one particular year, the dividend is not going to be increased all the way to the target. And the reason is that there's some chance that you're going to have less spectacular earnings the year after and the year after that. You want to avoid a situation of cutting. So all this put together means that the dividends are smooth compared to the earnings. So earnings are quite volatile, even though people try to manage them to make them less volatile. But the dividends are very smooth. And this type of model that Lintner proposed pretty well describes what goes on. If you look at the empirical evidence, and this is current year dividend, previous year dividend, and 2 years previous. And, I'm sorry, these are earnings. So on the left-hand side are earnings. And let me just get rid of location. So direction of earnings. So this is like 3 years in a row you've had earnings growth. And then we look at the proportion of companies that increased dividends, 81%. 8 maintained, and 11 actually decreased dividends. And this is a situation where 2 years previously you had negative earnings growth, and then the next 2 years you've got positive earnings growth. That causes 67% of firms to increase dividends, and 15% to maintain, 18% reduce dividends. So these are all different combinations. Maybe the most interesting one is the fourth one, where you've got 2 years of earnings growth followed by 1 year of negative growth. In a simple model, that would cause firms to cut dividends. A simple naive model that the dividend is just some proportion of earnings. but it turns out only 32% of firms would decrease dividends after 1 year of negative earnings growth after 2 years of positive earnings. And even if you go down to 3 years in a row of negative earnings growth, only 50% reduce dividends. So all of this data actually just supports this idea that dividends are a lot smoother than the earnings. That you really need a strong indication of the direction of earnings before you actually change your dividend policy. Yes?
Did he find any evidence of interest rates affected in making the comparison between investing and investing in debts? Would there be any interplay in different interest rates?
So the idea is if interest rates go up, then you increase your dividend?
Is he trying to
Try to compete. No, you didn't, but that'd be interesting to check out. That would be a dissertation. A lot of work, but doable. So is there a systematic interest rate effect on dividend policy? It's a good idea. Well, the answer is no. Nobody's done that. I'm not sure that it makes sense, but I'm going to think about it. Okay, so now let's talk about dividend irrelevancy. So there's two kind of irrelevance propositions I want to talk about today, and both by Miller and Modigliani. And actually, the one has to do with capital structure, and the other has to do with dividends. So I'll do dividends first, even though it came after the capital structure. So it's Miller and Modigliani, and what they claimed in a really famous article was that, well, dividends are relevant. The dividend policy is irrelevant. And this, what this means is that obviously if you change your dividends, you know, as a result of news within the firm, that's going to impact the stock price. Right? So you get some great news, you got some huge contract that goes out 20 years. It's going to fundamentally change the earnings stream of the firm, and you increase your dividend. Stock price is going to jump if it's simultaneously announced. So dividends themselves, or if you cut the dividend saying, oh, we're in terrible shape, we just can't afford to pay out the dividend, that is going to move the stock price. And that's what dividends are relevant means. The second part, the dividend policy is irrelevant. What that means is holding other things constant. So avoiding a situation where you've got the firm announcing some great new contract or a great new project. So just like everything's going on normally within the firm. And you say, well, if we change the style of payout, so let's say we pay out more in dividends today, but less in the future, is that going to manipulate or affect the value of the firm? Okay. And Modigliani and Miller argue that it should not fundamentally affect the value of the firm. The style of payout is not going to affect the value. And let me give you the really basic underlying intuition. And that is that the value of the firm is determined by the quality of its investment projects, the quality of the management, squeezing out as much positive net present value as possible. So underlying the firm is a set of projects. Okay. This is what determines the value. It doesn't make much economic sense to me that you can just manipulate the way that money is paid out to shareholders and affect fundamentally the value of the firm. You can kind of guess almost immediately what's going to happen. You have like the stock return is composed of two pieces. You've got a dividend component and a capital gains component. So if you increase the dividend component, the capital gains component will probably be decreased. Or if you reduce the dividend component, the capital gains component is going to increase. And the return on the equity is reflecting the underlying productivity of the assets. So to fundamentally change the return on equity just by manipulating the policy, the dividend policy, doesn't make a lot of economic sense. There's some exceptions, which we'll talk about, but just generally, it doesn't make a lot of sense. So that's the idea of the Miller and Modigliani proposition on dividends. Okay? And it was very controversial because when they proposed this, there was a school of thought that actually still exists today, but only with a very small number of people, that the dividend policy could fundamentally affect the value of the firm. And it was better to have that the firms that were paying a higher dividend would be valued higher because of the so-called bird in the hand sort of story. That you've got the cash flow versus what's in the future is more uncertain. Okay. And Miller and Modigliani came and basically dismantled that school of thought. And it was actually the beginning of modern finance when they actually did this. And both of these people collected Nobel Prizes in separate years for this proposition and the capital structure proposition. When did they win? Or when did they write?
When did they write?
They wrote this in 1963. It took them 25 years to win.
So does that sort of refute the idea that a company that pays no dividends and instead reinvests all of its money into research and development is inherently a stronger company than one that pays a dividend? Is that sort of?
Well, it's like, there's firms that pay no dividends. It's not like they'll never pay a dividend, but it's that they've got investment projects that they think they need to allocate the capital to. So they're not going to pay any dividend. It doesn't make any sense for them to pay. There's other firms that pay dividends.
That policy decision to not pay dividend and instead invest the money in other projects itself doesn't affect the value. Is that what you're saying?
No, absolutely not. It's a riskier firm too, sure. Whereas the firm that's got a steady dividend flow, probably a more mature firm. So just to, like if it was the case that the more mature firm manipulated the dividend policy so that zero was paid in the next couple of years and then higher later on, it's not going to fundamentally affect the value unless there's something else going on. Okay. Yes?
Would these guys argue that if a firm does decide to increase dividends, that the price of the stock would not be affected by that?
No. That the dividend itself can affect the value of the stock. Okay? What I'm talking about, and suppose that they increase the dividend because they really believe that there was like a really important announcement within the firm that they undertook a project that in gold or oil or whatever, and it fundamentally changed the earnings flow in the future. The increase the dividend, make this announcement, is going to increase the stock price. That's not what I'm talking about. I'm talking about just kind of the day-to-day, everything is going fine. And you're sitting down at the board of directors and people are arguing, well, if we do this, if we increase the dividend, is that going to fundamentally affect the value of the firm? And the answer is no, in my opinion. Unless something else is going on. Okay. There's a bunch of numerical examples that I go through here. I'm not going to go through all of these examples. Maybe we'll just do the first couple. 100 shares of stock, cash flow $100 in perpetuity. Discount rate is 10%. You pay a $1 dividend each year. And in perpetuity, these are really highly stylized examples, but they kind of get the point across. Then the price is $10. 100 shares means $1,000 market value of the firm. And then the next one is you pay $2 next period. You pay the remainder afterwards. Okay, so we're changing the policy, but nothing else in the firm. Okay? So we're increasing the dividend to $2 next period. And then whatever's left over we'll pay later. So we take the $2, discount it back to the present value, divided by 1.1. And then we got 90 cents going forever now. And the reason is that we've got to pay some interest on the amount that was borrowed. It's no longer $1.90. And we take the present value of that, and that's a present value at time 1. And we need to discount that back again to time 0. So divide again by 1.1, and we get a value of $10. So this kind of reminds me of that question, and I forget if it was last year's midterm exam question or this year's, where you had a bond, 8% coupon bond, and then they changed the coupon halfway through. Is that this year or last?
Last year.
Last year. So at 8%, then it goes 7 and 9 in the second half. Right? Remember the way that we did that? We kind of valued the 7% coupon, brought it back to present value, and then staying in year 10, we valued a 9% coupon bond. And then after we got that value, we brought it back to time 0. Kind of similar thing that we're doing here, except we're valuing like a 1-year cash flow, bringing it back to present value. Then we're valuing a multi-year cash flow at time 1, and then bringing it back to the present value. Now, when we did the bond example, it really fundamentally affected the value of the bond. It affected the value of the bond because we're taking away $1 and pushing it to the future. And it affected the value of the bond because obviously that you're worse off if that happens. Right? So $1 today is better than $1 10 years from now. This is not exactly the same thing here because we're getting an extra $1 today. Right? And then the future stream actually changes. Okay, so it's like the situation where in the corporate bond example, that instead of going from 8 to 7 and 9, we go from 8 to 7 and then something above 9%. Okay? And that would make the bond exactly equal in value in the two scenarios. So this example shows that just by changing the policy, it really doesn't matter in terms of the value. And the final one is instead of paying a dividend, you pay like a share of stock. So the firm then has 200 shares, and each one is getting a 50-cent dividend now rather than $1. So we can take the value of the shares, now $5, but you've got 2 shares. So you're back at $10 where you started from. So these are just some stylized examples that emphasize that it's probably not the case that the policy is going to affect the value. Yes?
What do you mean by policy? Is the timing of the dividends?
Yeah, the timing and the shape. Okay? And taking present value into account. Never, obviously, as I said, obviously $1 today is better than $1 next year. But taking present value into account, okay, just manipulating the shape, like the shape of the cash flows, after present value adjustments, is not going to affect the value. Yes?
In terms of the future risk of the flow, is that assumedly subsumed in the discount rate you're using?
Yes. And this is a real simple example where there's no risk. But it holds with risk. What are the sort of things that could be problematic for this proposition? Let me go through some factors that could affect. Taxes could have an impact on this proposition. There's 2 types of taxes, capital gain taxes and dividend taxes. And it turns out the tax rate is the same after 1986 on dividends and capital gains. But the effective tax rate might be different. And the reason is that you get the dividend, you're taxed that year on the dividend income. The capital gain is, you don't have to mark to market on your stock portfolio. So you can push that tax liability into the future. So effectively, there's a higher tax rate on dividends than capital gains. So as a result, that might cause some firms to lean more towards low dividend policy. Now to counter that, there's a lot of firms, or a lot of investors that don't pay any taxes. So I'm not convinced as to how important the tax effects are in either dividend policy or capital structure. What else? Transactions costs. That if you pay a high dividend, you might have to finance that dividend, and you might have to finance it by borrowing, you might have to finance it by issuing new equity. Both of those things are costly. So if it's the case that you push your dividend up to a certain degree where you have to incur these costs, then it might not be optimal to pay that high a dividend. Okay, so this is the sort of thing that could actually influence the size of the dividend that you actually pay. So transactions costs are very important. There's another thing called the clientele effect, which is maybe best described as a story. That some people believe that there are certain classes of investors that have a preference for, let's say, a steady dividend flow. That they'll pay a premium for a stock with a steady high dividend yield. It's extremely difficult to verify empirically, and nobody has actually done it, but it's a story that's kind of popular that people use to describe the benefit to a firm potentially with a niche strategy of a high dividend yield that's steady. I'm not convinced, but you should know that people talk about the story. And if people actually propose the story to you as a reason for a particular policy, you can always ask them, that's very interesting, but is there any empirical support for your conjecture? They're going to have a lot of trouble figuring that out. Okay? So there's a clientele effect potentially. I'm not saying that there isn't. It's interesting. What you're saying is true. It's interesting. But there's no real support for or against the proposition. The other thing is signaling. The dividend, as I said, itself is important because it potentially signals information. Now let me be a little more specific as to what I mean by signaling. What I think the main use of the dividend is to convey information from the insiders of the firm to the outsiders. The insiders have, like the management and directors of the firm, they know best what the value of the firm is. They got access to all the plans, the cash flows, the prospects. So they know what the value should be. And sometimes, it's the case that the stock market really isn't reflecting the underlying value of the firm. There's some deviation from the fundamental value. And sometimes this is an opportunity for the insiders to signal to the outsiders what the value of the firm should be. Now, perhaps the easiest way to do that is to call a press conference and say, well, our stock is $10 too cheap. But it's not really going to work too well. It doesn't have that much credibility. I think everybody would do that, right? Just call a press conference and say, our stock's too cheap. You need something with credibility. And credibility often comes with a cost. So if you do something that's costly, and say, what do you think? And that's much more believable in the market. And a dividend is costly. It's like cash from the firm going to the investors. So the dividend is a very credible signaling device from the insiders of the firm to the outsiders of the firm. And that's, I think, as I say, one of the main benefits. So you think the firm is undervalued, increase the dividend. Okay? And say that's the reason that you're doing it. That is a lot of impact. Okay, so there's a case where the dividend can actually impact the value of the stock without anything else extraordinary going on within the firm. So does that make some sense? As I say, it's not the sort of decision that you're going to be making immediately, but it's something, I've, have like direct experience listening to people, like at a board of directors meeting saying, oh, our earnings are down, we've got to cut our dividend. And you don't think about that, so you're actually deciding on the dividend. Does that sort of argument make any sense? Like, well, we're paying, like almost all our cash flow in dividend because our earnings are down. So our target ratio is 40%, but we're paying 90% this year. We got to cut. And my response is, you cut if you believe that this bad year fundamentally changes the prospects of the firm in the future. Is this bad year indicative of things to come? If it is, yes, cut. If it's a bad year because of certain economic conditions or certain things that are once and for all at the firm, then we should maintain the dividend. Because maintaining the dividend sends the signal from the insiders to the outsiders that the prospects of the firm are better in the future. So just to cut because of some transitory change in earnings doesn't make any sense. Yes?
As an investor, why am I going to get a stock with dividends as opposed to just getting, a bond and then just taking the corporate gain or the capital gain or the capital loss of the stock? I mean, why do I need a steady stream of cash flows from a dividend when I can just get it from a bond or something?
Well, I guess the bond and the stock have different risk characteristics, right? So there could be a reason to invest in the stock. It's not just the dividend versus the coupon on the bond. There's different risk characteristics. And I don't think that we should just have a preference over the steadiness of the dividend, right? Because the return you're actually getting on the stock is a combination of the dividend and the capital gain.
Right.
So even if it's a high dividend payout, there's still some capital gain component to it. So it's just a different asset. And you get a preference because of correlation or volatility. But I guess maybe what you're saying is to take the clientele effect to the extreme. You want to just, if you want something steady, you want to buy preferred stock, which is a fixed rate return, or bond. Because you perfectly steady stream and just avoid the effort, the combination. Yeah, it's kind of a counter argument to the clientele. Another question?
Has the signaling effect become less believable as more executive compensation has been tied to bonus based on stock appreciation? So I would think if I'm an investor, this credibility, if these decisions are made at the highest level, and Michael Eisner keeps increasing the dividend, I'm thinking he's making a lot of money off that. He's liable to jump ship in 3 years, and isn't truly signaling.
Okay, let me just slow down a little bit. Just because you're increasing the dividend doesn't necessarily mean the stock price is going up. It could be that they're increasing the dividend foolishly, right, with no reason whatsoever.
But I'm an outsider, and I don't know that.
Well, you learn. Okay, maybe you get fooled once, but then if the company doesn't deliver, and you've got people that are specializing in looking at the firm also, then it could actually hurt you. So you just can't raise the dividend and expect the stock price to go up. Okay, you've got to raise it with good reason.
So the idea of just raising it and saying I'm raising it because I know as an insider the value of the firm is $10 more than what it's selling at, it really isn't going to.
That should have some impact, right? And you have to make the case, right?
Yes,
you just wouldn't
yeah,
say it. You make the case to the investment community or the press or whoever. You make the case, and then it might not go all the way. People will wait, and then they'll wait for the quarterly cash flows, and they'll see if you're delivering or not. If you don't deliver, then the next time you try that, it's not going to have any impact until things are actually realized. So you only do this when you've got a high degree of confidence that you're correct. Any other questions on this? Okay. The other interesting thing, just to close this dividend discussion, is that many firms have totally different dividend policies. Like suppose that there's an optimal dividend policy. If that's the case, then I would expect, at least within an industry, to see clustering around a particular dividend payout. But you don't. So you look at firms, you see firms that pay nothing. You see firms that pay a high dividend. You go within the industry, you see the same thing, maybe a little less variability, but there's no clustering around some particular payout. So to me, maybe that's the strongest empirical support for the Miller sort of argument. That if there was truly an optimal dividend policy, then you would see people going in and kind of arbitraging it. So they take the firm that's a suboptimal dividend payer and buy it, change the policy, increase the value, and then sell and get out and make some profit. It's rare that anything like that happens. Okay, there's the only recent thing that's even close to this is the cash stockpile at Chrysler's. Okay, and some people think that it's not optimal for them to be sitting on this stockpile. There's some talk about taking the firm over and changing its dividend policy. It's not clear that's going to happen. And it's only one example, and I can't really think of other examples offhand. But if it was truly the case that there was an optimal policy, and given how smart people are in the market, then we'd see some clustering again. Okay, yes.
With growth companies, you tend not to see any dividends. And how does that fit in with this? I mean, is their theory only apply to mature companies, or is it to...
No, to any company. You don't see any dividends. That doesn't mean that there'll never be a dividend.
No, I agree
It just
with that.
means that for the past 20 years they haven't paid a dividend because they're taking the money, plowing back into the firm's investments.
I'm thinking of this in terms of the kind of stuff that we're doing in macroeconomics, where they're talking about marginal productivity of capital. Okay, and it seems like a growing company, basically it's going to be more productive for them to invest essentially in their own company and capital in the corporate company. Once it becomes mature and they start getting excess cash, that's where it seems clear to me that this is absolutely right. In a way, it doesn't matter if they keep the money. They're not going to invest in more capital in their own firm because it's not going to pay off for them. So they'll suddenly start investing in other things, in perhaps in other companies. And in essence, it doesn't make any difference in a macro sense whether they do the investing or whether they give the dividends to the owners and they do their own investing. So I see there why it doesn't matter, but it seems at least early on, that in the company, while it's still growing, that they're better off.
I guess you could make the case that with the growth firm that's not paying any dividends, if you alter the policy, that's going to, is that going to affect the value of the firm? And I guess it's not 100% clear to me because we'll alter what's going on, right? With no dividends, you've got a very high rate of return on the stock. If you start paying out a dividend, then that's going to reduce the rate of return on the stock. Right? But you're also getting the dividend payout. It means that they're not investing at the same rate in these positive NPV projects. It's going to change things, but the overall value of the firm, I'm not convinced is going to be fundamentally altered. The problem, you can never test this because you just don't see things like that happening. Right. It's just like these zero dividend stocks. There could be something in the case that you're making on that the value actually incorporates this expectation that in the future these really positive NPV projects are taken. Sure. When they start paying it out in dividend, then we couldn't take those projects. So that's where this could break down and your case would be supported. That's possible, but difficult to test. Yes.
Kind of along those lines, that there's also a lot of money in income funds that can't buy these good growth companies just because they pay no dividend because of all this money is earmarked for only dividend paying stocks.
Right.
So you could get a little kick, it wouldn't be a permanent.
Yeah, you get also growth funds out there, a lot of money in
Yeah.
growth funds, so.
But it's okay if they pay dividend also and also grow.
Yeah.
It's just a little extra money that could kick into the share price.
Yeah, again, I'm not convinced that it's, though that could be something that you could empirically test. If you have the data on the income funds and you can see if there's any marginal impact on that. But you also want to take the other funds into account. Give us some, yes?
How strong a signal is it for a company to buy back its stock instead of like increasing dividends? Is that a better signal in your opinion than if the company were to boost their dividends? If you saw them buying a bunch of their own stock with their excess cash?
In my opinion, it's not distinguishing the two actions. I guess like the folklore is that if you reduce the amount of equity outstanding, then it can have some impact. But I have no empirical evidence that there's any difference in the two actions. They basically do a similar sort of thing. My personal preference is the buyback.
The buyback?
Yeah. More important. Yeah.
How important is the signal in the scenario you talked about? They have 1 year, bad year, they don't want to, the prospects for the long term haven't changed. Would they go to as far as stand as to borrow cash so
Yes.
that they can keep the
Yes.
escrow going?
Yes.
So that it's not important that they go with that.
Well, it might be dead already.
Well, further than.
Yeah. That they consider that important enough to do. Sure. It's not uncommon. Well, actually, you think about it, if you're just borrowing in general.
But it's not really helping the firm as far as their prospects for the future. It's only manipulating the stock.
There's no manipulation. It's not, we're not talking about manipulating the price.
But I mean, that cash you're taking in, you're borrowing just to pay out as dividends. It's not being invested in the firm and helping the long-term prospects. It's just so that you don't send out a negative signal.
Which is very important, because it's signaling something with a longer-term cash flow. Also, they borrow at a fairly low rate. Yes?
In the growth company example that Mark was talking about, would there be any difference between, not paying any dividends and reinvesting all of their income, or paying a dividend and borrowing the same amount as the dividend you paid out, and then therefore reinvesting the same amount?
Yeah, okay. What that, I guess, is getting us towards is capital structure. So let's talk about capital structure a little bit. It's going to be the capital structure. What I mean by that is the proportion of debt and equity in a firm. Okay, so a so-called unlevered firm is a firm with 100% equity financing. A levered firm has got some debt in the capital structure. Kind of the notation in the lecture note is that S represents the stock and B represents the bond or the debt. The question is, can we manipulate the capital structure to affect the value of the firm? And this is the original Modigliani and Miller proposition. And this one is 1957, earlier. And they argued that the capital structure of the firm, in the scenario of perfect capital markets, no taxes, and a bunch of other assumptions, the capital structure of the firm shouldn't affect the value of the firm. And the intuition that they gave, well, actually didn't give this intuition, I'll give this intuition, is that you can consider the value of the firm like a pie. And then, it's financed with debt and equity. And 50%, 50%, you're kind of like cutting the pie in half. 2/3 and 1/3, or 3/4 and 1/4. Basically different ways to slice the pie. The size of the pie, the area, if you want to call it that, is determined by the productivity of the investments, quality of the investments. So if you have really good investments, then it's going to be a larger pie. Less good investments be smaller. So it doesn't make any sense by slicing the pie different ways that you can manipulate the actual size of the pie. And that's kind of the foundation of their proposition. So it doesn't really matter how it's financed. What really matters is what you're financing. And that's the so-called M&M proposition. So they argued that capital structure itself was irrelevant. And they went through, and as I say, in the notes, there's lots of little examples. The no tax scenario, and some of their assumptions are listed, which are important, obviously, because one major assumption is no tax. It's a critical assumption. It's not a very interesting assumption to make, but at least to start things off, it's the right thing to do. So let's go through, I guess, a couple of these examples. And let's back up just a little bit. Firm earns $100 in perpetuity. It's all equity, 100 shares of stock. Sells for $10. So the value of the unlevered firm is 100 times 10 is $1,000. Now assume the CEO decides to issue $500 in debt, and then the price of the stock should drop to $5 a share. So the value of the levered firm now, so L represents levered, is the value of the debt, which is 500, times 100 shares times the price of the share is $5. The total is 1,000, which is identical to what we had before. Now the question is, why does the stock drop to $5? I just assume the stock went to $5. That's really what makes this work. So, in the unlevered case, if the firm is paying $1 in dividends forever, and the interest rate is 10%, then the price of the stock is $10. In the levered case, the firm has to pay interest. The interest payment is $50, 10% on 500. So that means what's available for dividends is only 50 cents. So 50 cents in perpetuity is $5. So basically, you get back to where you started. Okay, and this is a very simple example. It's got like constant interest rates, no uncertainty, no taxes, and everything basically works. So the value of the levered firm equals the value of the unlevered firm. As I said, I'm not going to go through all of the details of this, but what I want to talk about are two main things. First is to calculate the rate of return on the firm, and this is sometimes called the cost of capital. And the cost of capital is going to be the weighted average of the return on the debt and the return on the equity. So the return on the debt is RB, and the return on the equity is RS. And the weights are just the proportion of debt and the proportion of equity in the capital structure. This is sometimes called the weighted average cost of capital, where the weights are just the proportion of debt or equity in the capital structure. Now, we can solve for the return on equity, and the return on equity is the overall cost of capital plus the debt divided by equity times the cost of capital minus the return on debt. And this suggests that the return on equity is going to be positively related to the debt-equity ratio. So the more debt you have in your capital structure, the more you have to pay out in terms of an expected rate of return to the equity holders. The riskier the firm is, the more investors are going to demand in terms of compensation. And the debt to equity tells us something about that. So higher debt to equity means higher rate of return on the equity, which is consistent with the proposition proposed by M&M. Okay? Now, I think quickly what we have to do is to introduce taxes. It turns out that M&M published a follow-up article in 1963 that basically seemingly totally reversed their conclusion of the earlier article. The early article says that capital structure is irrelevant. The later article says that capital structure is relevant. For them, this is perfectly consistent because the early article assumed no taxes, but the later article assumed that taxes exist. So it turns out that when taxes are there, that there's we're not slicing the pie two ways anymore. There's a third party. That's the government. Okay. So let's go through a simple example. And let's use a tax rate of 34%. And it turns out that interest payments, as you know, are tax deductible for the corporation. So if there's an unlevered firm and earnings are $66, you pay 66 cents in perpetuity. The levered firm, you're going to have interest payments of $50 each period. After paying taxes, they can pay 33 cents in dividends in perpetuity. So the value of the stock is 3.3. Go to the value of the levered firm, it's $500 in debt, plus 100 times 3.3 is 830. So this interest deductibility has actually increased the value of the levered firm from the situation where it was unlevered. Okay, so the first situation, there's no debt, and the value is 660. The second situation, we've got 50% debt, and the value is 830. So clearly, in this situation, we want to take on some debt. And the intuition as to where this is coming from has to do with the deductibility of the interest. And actually, if you look at the difference, 660 and 830, it's $170, which is, remarkably enough, 34% times the $500. This is sometimes called the interest tax shield. And it's basically what the government is giving you extra. So in a way, the size of the pie is increasing as you kind of like fit in this extra slice out there. There's like this up, you've got the pie, and then there's this $170 slice that we're going to force into the pie, and we're going to expand it. So it used to be 660. Once we put the government slice in, it turns out to be 830 with the debt. Okay, so the government basically, by subsidizing, increases the value of the firm. Okay. So effectively, now we have to change the story. So before we said the capital structure was not relevant. Now it is relevant. That by increasing the amount of debt in the capital structure, you're increasing fundamentally the value of the firm. And what we're doing is we're adding this extra government piece. So in a way, the first M&M article said, well, it doesn't matter what the capital structure is. It could be 0, it could be 100% debt, and the value is going to be the same. Now what they're saying is, what is the optimal amount of debt in the capital structure? 100. All debt. Which is so much cheaper, and you get this benefit from the government. So you might as well go for debt. Okay. Now it turns out that this also affects the cost of capital formula. Let's scroll ahead to it. Actually, I don't see it, so let me just write it down. I think it might be reserved for the next lecture. You should definitely know this for the corporate finance course. So the cost of capital, the return, equals the amount of debt times the return on debt plus the amount of equity times the return on equity. Okay. And this is the no tax weighted average cost of capital. And it changes to the following. Okay, and this is the corporate tax rate right here. So taxes definitely affect the overall cost of capital if the firm's got debt. If this is a 100% equity firm, then it's irrelevant. So the taxes introduce something extra into the problem that push you towards 100% debt. Now, you think of this proposition, that the initial proposition said that the mix of debt and equity was irrelevant. And probably some of you scratch your heads and wonder, maybe that doesn't make a whole lot of sense. This proposition is also pretty extreme. It says, well, you might as well just do all debt to get the maximum benefit from the government. And that's a bit problematic too. So what we really want is something in between. There's going to be certain things that maybe we'll talk about after a break that will cause us not to go to 100% debt. So in contrast with the dividend policy, where I really believe that the policy doesn't fundamentally affect the value of the firm, that with capital structure, I believe that there's at least a range of capital structures that are more optimal than others. So let's talk about the reasons for the existence of such a range after we take a break. Okay? Go at 100% debt. And there's some obvious problems with that, because if it was truly the case that your formula is correct, a very simple formula, it says go to 100% debt. If that was the case, then we could do a simple empirical test by looking at what firms do. And we would quickly reject the hypothesis that we should be at 100% debt. So there's a problem with the implication based upon the assumptions of the model. But let's talk about some reasons why we don't see 100% debt. Any ideas? Increasing the risk. Yeah, you'll get compensated for it. Who's risk? Who's risk?
Well, I mean, there's more interest payments you have to make. You definitely got to have the cash flow to make those. So,
Yeah, but, okay, but you definitely have to have the
Well,
cash.
equity financing, you have to give them back anything over that time.
So you can take the dividends to zero, right?
If you can't afford it, well, that's kind of the shareholder's problem.
Right, that's exactly the problem, right? That you have flexibility with the equity.
Bank doesn't have the same
Bank doesn't have flexibility there.
All right, the bondholders may increase the cost, for you to get the debt, so it may end up making it advantageous instead of doing the debt to go with the equity.
What do you think of that? So there'd be some advantage?
Yeah, once when you reach the point there's this chance that you might not get your money back, you're gonna hike your interest rate as high as possible.
Right, so in a way, that was a very interesting idea, that in a way, when you go to 100% debt, that what the debt holders have looks very similar to what the 100% equity holders have, right? So that's a situation of kind of a jump fund. So you notice if you look at the returns on jump funds, they look very much like equity. That's basically what they are. Equity. Except the difference being that you've got this reduced flexibility because of the high interest payment. So it looks like equity, but it isn't equity because you get this fixed payment. Now often they look like equity because when they originally issued, they weren't junk debt. They were high quality debt with a low coupon rate, and then they've fallen into trouble, and the price of the bond has gone down dramatically. Yes?
There's no real benefit if you're now loss operating.
If you're what?
If you're now operating loss, there's the benefit of the interest effect, which is increasing your losses. And you're not really seeing anything of that today.
What accounting people help me out on that? 15 years? And you go backwards too, right? Yeah. So, but that still could be an issue, right? That if you're carrying it 15 years or more, then the value's not going to be that high. Okay, so you could exhaust the benefits of the tax deduction.
What do you do with the supply and demand of money of itself? Everyone demanded debt, so demanded money to drive up rates to, say, an amount that where a rate was high enough that there would be an opportunity for you to issue equity so you get a higher return on your money, and that causing an equilibrium within the market.
Do I believe that the supply of corporate debt affects the interest rates? Yes. But it's also probably going to affect the equity returns, as it should, because that formula that links the equity returns with the leverage ratio definitely comes into play. But you're suggesting that there's some point where the debt, if everybody is issuing the debt, then the rate on the debt could go high enough to reduce the advantage because of the supply constraint. I believe that's possible. I believe it's also very difficult to test for. So maybe it's possible. Yeah.
I would argue on a smaller scale that as a company's debt load gets higher and higher, the banks are going to demand higher and higher interest rates.
Absolutely.
And so it eats away at the advantage. Eventually, you get no advantage if you're 100% debt. Who wants to loan to a company with 100% debt? Because that
Part of the advantage is that you get to deduct the interest. So
You deduct
bigger
the portion.
deductibility, right?
you deduct a portion of the difference.
Yes.
You have to pay for that.
That's true. That's true. And eventually, as I say, you get to something that looks like the equity return.
Yeah, I guess I'm thinking about two things here. One is that if it's other companies investing in them, don't they have to pay taxes on interest received, but don't have to pay taxes on dividends? So there's an advantage for them to invest in stock rather than in bonds. And the second thing I'm thinking about is that, again, going back to growing companies. So my feeling that a lot of companies that are first growing may be owned by one person initially, and then they start off. They actually do start off with an incredible amount of debt. I'm thinking about my college roommate who started his company, basically. He knew he was going to get enough money coming in within a year to pay off any debt that he accumulated, but he basically financed the first 6 to 8 months on credit card debt. And at some point, he's hoping that it'll be big enough where he can then sell equity and essentially, get money and probably retire.
That's probably the reason that so few startups actually make it through.
Right.
Because of the huge leverage, and given it's so small, the bankruptcy costs are pretty small. So one of the negatives here, when you go into pretty high leverage, is that you increase the chance of bankruptcy. And bankruptcy is costly in many ways. People who benefit from bankruptcy are lawyers, the accountants, bankruptcy accountants, the court system. It's a real mess. And probably the people that really take a hit are management, who lose jobs. One of the people here, Michael Bradley, has actually written a number of influential papers on abolishing Chapter 11. He's kind of a leader of that area. And he argues, it's kind of interesting, that he argues that it's Chapter 11 is like a crutch that a lot of firms just grab for when they shouldn't really go into Chapter 11. Like it's just another subsidy for these firms that they could probably make it through, but they just go in there to get protection for a period of time. So that's kind of consistent with all of this stuff. So bankruptcy is something you definitely want to avoid, and therefore that's going to reduce the debt equity ratio. Okay? So if you push it too high, you really increase the cost of bankruptcy. And I guess we hit the other points that are important there. Exhausting the benefits. One thing we didn't get are conflicts of interest. And that's kind of hard to kind of initially see. Let me talk about that. I think it's the most interesting. That the value of the firm is the debt plus the equity. The value of the debt plus the value of the equity. And the value of the firm fundamentally is determined by the quality of the investment project. Right? So we've got this fundamental value of the firm, and we know that it's divided up between debt and equity. Well, it seems like the shareholders potentially have this opportunity that they can increase their value without affecting the value of the firm by expropriating from the debt holders. So if they do something, so given the value of the firm, if the shareholders do something to make the debt worth less, then that's going to increase the value of the stock. Okay, so if it's putting numbers to it, the fundamental value of the firm is $100, like $10 in perpetuity. You have $50 in equity, $50 in debt. If the stockholders can do something to affect the value of the debt, if they can reduce the value of the debt to $40, they're going to increase the value of their stock to $60. Okay? The overall value of the firm remains the same. So there's this incentive, and it's called the incentive to expropriate from the bondholders. Now, how does that work? Suppose that the equity holders want to raise some debt because they know there's some tax advantage to debt. And it turns out that the bondholders know exactly what's going to go on. The bondholders, the potential bondholders, know that there's a chance of expropriation. So as a result, they're going to either demand a very high coupon or price the bond quite low, which will deliver which will deliver a rate of return that compensates for this probability that they're going to be expropriated. Yes?
Well, or just bond companies.
But who actually wants to initiate the bond companies? That's the interesting thing. Actually, it turns out that the stockholders have the interest in making sure the covenants are really tight. Because if there's no covenants, then it just means that the coupon rate on the debt is going to be very high. Bondholders, that's fine. They're being compensated for their risk. And the cost of the debt is quite high as a result of that. Now, let's layer on some covenants. Okay, very tight covenants saying that you can't do certain things, you can't borrow to pay dividends, you can't do radical asset substitution by like dumping things that are fairly safe and buying things that are very risky. You can't issue debt that's senior to the other debt. That would expropriate. So all these things are written into a contract. And what happens to the cost of debt? It's reduced. So in a way, all of these so-called conflicts of interest between bondholders and stockholders, it's in the stockholder's interest to resolve them. That the stockholder actually bears the cost of these conflicts of interest. It's the stockholders that actually want to have these detailed covenants because it reduces the cost of debt. It's kind of interesting. And as a result of this, sometimes it's called agency problem also. But as a result of these conflicts of interest, you're not going to get a situation with 100% debt. That very common thing in the covenant is to have a cap on the debt-equity ratio. So even issuing subordinated debt, so debt that's junior to the initial debt, the debt with the covenants, it can't go on to beyond a certain point. Okay, so these conflicts of interest will basically establish like an upper bound on the debt-equity ratio. Okay? And this will cause the M&M proposition to break down. So all of this together indicates to me that there's probably regions whereby the capital structure is more optimal than other regions. And I think a strong case can be made that zero debt in the capital structure is probably not optimal. Now often you see zero debt in situations where it's a firm that's privately owned, but not a startup. Where the owners have a real aversion to any probability of bankruptcy. And you can effectively eliminate the bankruptcy scenario by having no debt. Not entirely, but effectively. Yes?
What about those companies that are cash cows? They are like insurance and stuff. Do they just produce so much cash that they need debt? Is that another category, or do they just get debt for tax purposes?
Well, financial services are usually like treated differently than any other industry because they're so unique. Where debt equity ratios are, like for banks and stuff like that, massive. Compared to anything else. So they have to be treated differently, I think, in this case. Usually they are. But I guess maybe the troubling thing is that if we do look across, within various industries, you do find much different debt equity ratios. It's kind of like the dividends. You don't find necessarily the clustering, which I think is a problem. That I believe that some debt in the capital structure is a good thing. It's kind of obvious that you're taking advantage of some government money, basically, with some debt. With zero debt, you're not. And it could be optimal for the owner of the firm not to have any debt because that owner has a particular utility function that says, I don't want to go bankrupt. Okay? Or if the management somehow controls what's going on in the firm. And the management knows that if they go bankrupt, they lose their job. And they've got a real preference for not losing their job. Okay? So therefore, they'll propose a policy. And they might even try to trick the directors. Use smoke screen and all these arguments that don't make any sense. As a reason to keep either the debt very low or zero. I think a strong case could be made that you should have some debt in your capital structure. Now, what about the reason that there's no, 60% or 50%? Like in a way, it's a little unsatisfactory. We can't put up a formula like the Black-Scholes formula and plug in some numbers and it says 63% for this firm. And we can't do that. And I don't think we'll ever be able to do that. It's just way more complex than something like the Black-Scholes is. Black-Scholes is fairly easy. You've got some derivative security on an underlying asset that's traded, and we know something about that traded asset, and we get the value of the college. Optimal capital structure is very complicated. A number of things going on, including these conflicts of interest, which are very difficult to model. Now, let me tell you the only case that I can think of that makes sense for not going all the way to, a higher debt-equity ratio. A lot of firms, what they do is to have some reserve debt capacity. So the idea, and maybe one of the most fundamental ideas in finance, is that to create value for the firm, that what you need to do, if a positive net present value investment arises, you need to be able to act quickly and go for it. Because the positive net present value investment is going to increase the value of the firm. So what firms do, what some firms do, is that they will calculate what their so-called debt capacity is. Okay? We think that we can go to 60% debt to debt plus equity. Okay? But currently we're at 35%. So they're holding out 25% of their capacity. And often the capacity is defined as lines of credit from the bank, like guaranteed financing that they can get. And potentially guaranteed financing that doesn't affect their credit rating, or it doesn't affect the rate of interest that they're actually paying on that credit. So they know they can go to 60, but they're at 35. And they're holding that 25% extra capacity for a situation that might arise where they need to act quickly, like an acquisition or just some really good project, so that when they need the cash, it's very quick. Line of credit is almost instant. Finances the project. So I think that that's perhaps the only good reason to have kind of a lower than average debt-equity ratio, because you're hunting for the net present value project that's going to enhance shareholder value. Okay. Now, you could argue that even if you were at 60% debt to debt plus equity, and this great project arose, that because it's a great project, somebody would be willing to finance it. You could issue equity, for example. In all of these models, you've got perfect capital markets. Capital markets are not perfect. To issue equity is not an easy thing to do. To issue equity is extremely costly. It's not instant. So to issue equity is actually costlier than issuing debt. So what you'd like is just to be able to expand that credit line. It's all pre-committed, and you can act very quickly. And speed is so important in today's corporate world. So that's the one argument that I can see to kind of hold back on the actual capacity. Because you've got a strategy, it's very explicit, and you might even tell the shareholders that, look, we're at 35%, we know we can go to 60 to get these extra benefits. But we believe that this is a strategy that will enhance shareholder value in the future. Yes?
Can you do the same thing with equity, though, by having treasury stock available?
Yeah, but still, it's costly to issue.
Right, because it's going to move the market.
It might move the market, and you might need to act incredibly quickly, like within a week. And to issue equity in a week is going to be very difficult. So this is just gives you more flexibility, and you have to trade off the cost of the flexibility with the benefits. But as long as the firm has thought about it, it makes a lot of sense. So the bottom line here is that unlike dividend policy, where it's just unlikely there's an optimal policy, there's probably a range of debt-equity ratios that are more optimal than another range. For example, like 75% to 100% is unlikely an optimal range for a firm that's anything but a startup firm. Okay? It's just too high, that the costs are too high at that point. And it's also unlikely that 0 or in around 0 is optimal either. But in between, you can make the case that there's some optimal range that depends upon the firm's strategy, the industry, the particulars of the firm. Okay? But what you should avoid really carefully is you need to avoid the situation where the manager of the firm is simply acting in their own self-interest to keep the debt low to reduce the chance of bankruptcy. That's not what you want. That's not a valid reason. To eliminate the bankruptcy possibilities is okay to a certain degree, but to push the probability to 0 is probably not optimal. The cost of doing that is greater than the cost of actually bearing the bankruptcy costs. Okay? Yes?
Do you have any information on how this varies in different countries with different tax codes and policies?
No. And the reason is that it's such a, I actually embarked on a project once about 4 years ago just to collect the tax information in the different countries. So I had a spreadsheet built, and there's an accounting firm that is pretty good in publishing a book for each country. Or no, it's a book for all the countries, but they do it every year. So it creates this spreadsheet going back to 1975 of all the differential tax rates in about 25 different countries. And it's just about to start to do some work on a topic like this when I realized that, like in the US, the data was okay, and the UK and all of that. But then I realized that a lot of these tax rates in these countries were negotiable. So while it published at 25%, it doesn't mean that you pay 25%. So you get around it by doing something else. And I just, if that's the case, then I can't do anything. I learned something about taxes. It's very important. It's really critical in project evaluation to have a good tax person, international tax person. And that person should always be on the phone with the tax accountant. Very important person. Can't do this alone. Can't do it from a lecture down there. Okay? It's very complex. Okay, well, the last thing I want to talk about here is debt and equity as options. This is the probability distribution of firm values. So value is on this axis and the probability up here. And B is value. And A is the amount that's owed to the bondholders. Okay, so this is a probability distribution, let's say, at the end of the expiration of the debt. So obviously the expected value is at the highest point here, the way I've drawn the curve. And the expected value exceeds the amount owed to the debt holders. If it's the case that the value does not exceed A, then the debt holders get whatever the value is. If the value of the firm exceeds A, then the debt holders just get A. So we could also do it by the stockholder. If the value is A or below, the stockholder gets nothing. If the value is above A, the stockholders get the value minus what's owed to the bondholders. So we talked about this before when we talked about options. What, if we put this in terms of options, what kind of options have the stockholders bought or written? Paul, and have they bought it or have they written it? They've written it. So with a written call option, if value goes up, what happens to the value of the written call option? It goes down. So for stockholders, if the value of the firm goes up, what happens to the value of the stock? No, the value goes up, right? So as the value of the firm goes up, the stockholders should actually benefit. So in this case, it's actually, you're correct, it's a call option, but it's a long call. Okay, so as the value goes up, the stockholder doesn't. That's all. We can actually, this didn't turn out, I gotta put some character terms in. Let me just write it out on the overhead. So payments, B is less than or equal to A. B is greater than A, and position. Should be a familiar style. So the first one is the stockholders. If the value is less than A, they get nothing. If the value is greater than A, minus A. So the position is basically what? Call, and I make it a call, which has got an exercise price of A, time to maturity T, and let's say sigma for volatility. The bondholders, if the value is less than A, they get whatever the value is. Because they're first to get money in a trouble situation. If the value is greater than A, they get A. Right? And it turns out that what they've done is their position is like V, the value, minus the call option. And total everything, we get V, we get V, we get V. Total.
Sorry, what's that symbol here, the last symbol right here?
Oh, sigma, for volatility, sorry. Yeah, absolutely. Let's graph the payouts. That'll help. Okay. This is the payout to equity. So they get 0 up to A, and then they get B minus A. Right? That's pretty clear. Pretty clear that that's a call option. Right? So often just graphing this is going to help us figure out what the payout is. So it's a long call. And what about the debt? Well, if the value is greater than A, you just get A. And if the value is less than A, you just get V. And the question is, why does this equal V minus the call? So let's do this diagram, figure out where it came from. A. Okay. So let's do the different pieces. So I'm conjecturing that it's the value minus the call. Okay, so the value is this. And a written call minus C is a written call. Looks like this. That's minus C. Put those two together. So add them together like we usually do. We're adding 0 to this, and you get this portion here. And then the B is going up, and the C is going down, and it flattens off. So this is B minus C. Yes?
Preferred stock would just raise the exercise price for regular stockholders.
Say it again?
If there was preferred stock, that would just raise the exercise price for the stockholder, being careful stockholder.
We would have to introduce an additional asset. analysis. But the question is, can we do this in terms of options still? And the answer is yes. So we can see it's B minus C. So the bondholders, it's like they've got the value of the firm, and then they've written a call option. And the call option is what the shareholders are. Is there, let's take a look at this diagram again. Bondholder payout. If you just done this diagrammatically, it's easy to figure out this payout, right? Bondholders. Is there another way that we could represent this payout in terms of options?
I'll take a lucky guess here. You could do it in terms of puts.
Ah, okay. Well, let's think about that. Makes sense. So what do we want to do in terms of the put? So let's draw. So what do you want? Put?
Well, I mean, we could work it out in terms of put call parity to figure out exactly what we should.
Well, let's do that. You have to speak up, I'm sorry. Yes?
Let's say it looks like a writing a put, and then plus present value of the exercise.
Okay. So let's look at that. So writing the put is going to be, so we lose when the price goes down. Okay, so that's minus P. And the present value of the exercise price, what is that? It's like a risk-free investment, right? So you invest the present value of the exercise price in a treasury bill, just like we did with put call parity. So that's going to be, that's not going to depend upon V, right? So this is the final payout. These are all gross payouts, not net. So put those two things together, and we get this thing up here. So this thing is also can be represented as an investment in a risk-free bond, right? So risk-free minus put. So think about this, think about the intuition here. That if everything goes fine for the firm, you're going to get this. And the difference between this risky corporate debt and a risk-free bond has to do with the downside. So on the upside, they're identical. You're going to get A. On the downside, to make the risk-free investment look like the corporate bond, we need to lose something when the price goes down. And the only option that does that is a written put. So the bondholders effectively have a risk-free investment, and on top of that, they've written a put option. The value of the firm, strike price of A, time to maturity T. So this is like a way to view capital structure in terms of options. And actually, I should mention that the original Black and Scholes article in 1973 was actually called, I forget the exact title, but it was called something like Option Pricing and the Valuation of Corporate Liabilities. So these guys saw it right in the original article that it's a way to view the firm as well as viewing derivative assets on the equity. Okay? And it's also you know, if you look through that final exam from last year, you see questions like this. Like the value of the bondholder stake equals the risk-free bond plus a written call option. True, false, why? With no points for true or false. Okay. And often, to answer that question, you need only draw the payout diagrams. Okay, so if you drew the payout diagram for risk-free minus a call, you're going to get something that does not look like the bond value. Because the correct answer is risk-free minus a put. So you would answer F plus a little diagram, no words even. You get both ones. Okay. So this is just a way to integrate kind of what we did in options to some problems in corporate finance. We're going to do more of that because in the very last part of the project evaluation lecture, I talk about using options in terms of evaluating projects. Okay, well, we've got a few minutes left, and I want to talk about I want to introduce project evaluation. So this might be the most likely thing that you actually do in the short term, either in the summer or initially get to the corporation. Maybe some of you have done this already. And it has to do with evaluating investments. And I call it project evaluation. Some people call it capital budgeting. We talked about it before in kind of a general way. Remember we started with that initial example of 10, 20, 30, 40, 50? And we figured out, using arbitrage style arguments, what the value of those cash flows was today. And it was a highly stylized example because the cash flows were known for sure. Okay. And there's some examples in this lecture where we've got known cash flows, but we're now in a position where we can be a little more general on this. So we now have a model that tells us what the discount rate should be. So when we discount a project that looks exactly like the firm, we'd use the weighted average cost of capital on an after-tax basis. So it's a blend of the cost of equity, which we get from the capital asset pricing model, and the rate on debt after tax. And that's the discount rate that you're going to use to evaluate the project. And it's critical that this project has got to be the same style project as the firm. Okay, if it is a different risk, then you need a different discount rate. So a lot of this lecture actually just goes through some examples of capital budgeting and points out some problems that sometimes occur in capital budgeting. So the first thing is kind of a basic sort of item that I say, but I really can't emphasize enough. That the more positive net present value projects that the firm undertakes, the more you do that, the more the value of the firm is enhanced. The simple calculation to take the value of the firm with the project that's got positive net present value and the value of the firm without the project that's got positive net present value, and net present value basically is almost defined as value enhancement. So the more that you do of that, the higher the value of the firm. Okay, and as soon as you start taking negative net present value projects, then you will destroy firm value. Okay, so it's like the most fundamental thing, and we really have to understand what this present value actually is. Okay, and it's not just a matter of discounting. I've got plenty of examples of, this is one where a computer, you're thinking of upgrading. The cost of upgrading is $200,000. There's going to be a 5-year useful life of the new computer with no salvage value. It's going to save $75,000 a year. And the current market value of the computer that's in place is $100,000. It gives you the cost of capital at 15%. And the question is, should you upgrade? So this is real simple. We know what the cost is, $200,000. We know what the benefits are, $75,000 a year for 5 years. We know what the discount rate is. You can easily work this out. The net present value of this is positive, $51,410. We should upgrade. It's clear that we should upgrade. The salvage cost of the old computer is not included in this calculation. We always look at this on the margin. Should we do this or should we not do this? Okay? So as I said, there's lots of examples here of net present value. And I think that the basic message or the mechanics of doing this are pretty straightforward. And that's not what I want to pitch in terms of my time on project evaluation. Okay, so all the notation here, and it's fairly mechanical. For example, one important thing, just like we talked about the interest tax shield for debt, one important thing we have to consider is the way that depreciation affects the value of the project. So it turns out with depreciation, it is another way that the government gets in and gives us a benefit. So we get to deduct the depreciation expense even though it's not a real dollar expense. Okay? It's an allowance given to us by the government. So depreciation, even though it's not as like an accounting number, it actually has some real economic content. And it always has to come into the calculation. But my design of this lecture is not to show you how to do capital budgeting. I think that this whole course is on capital budgeting that you could take. And I think you need to know the basics. In the second and third corporate finance courses, you do much more of this. You need to know some of the basics, and I've written down here the kind of formula for net cash flows. So revenue minus expenses minus tax minus the actual investment and plus the salvage value, everything at time t. And then you calculate your taxes as the revenue minus expense minus depreciation. This is where depreciation comes in. And then you can see that after you do this tax, that you get after-tax cash flows, which are revenue minus expenses, plus you've got this T times DT. So this is very similar to the interest tax shield, but now we've got it coming off depreciation. There's certain things like that you have to know when you do capital budgeting. But what I want to focus on is not the mechanics of this. What I want to focus on is kind of like 4 major errors that people make in capital budgeting that I see when I go out in the industry. It's not errors that are just made by small firms. These errors are made by large firms too. And I think it's very important you realize what these mistakes are and avoid them. Yes?
When you're looking at the NPV, would you also consider what your risk-free return would be for that same amount of money?
It's already calculated. In the discount rate, it's already there. So the discount rate is, if you recollect, if it was 100% equity firm, would be the risk-free plus the beta times the market expected return minus the risk-free. So the risk-free is already there. So you need not do that type of calculation. You could, if you wanted. And the way to do it would be kind of like a roundabout, where you can calculate the return by pulling out the risk-free in the discount rate, and then compare it to a risk-free return. I would not recommend it. It's basically already there. So you expect to get the risk-free plus something else reflecting the risk of the project. Okay. I'm not going to decide on this for a long time. I don't want to. But there is a way to do what you want to do by creating a different version of the project under certainty. And it's called calculating the certainty equivalent value. And that's talked about in the advanced corporate finance course. But let me just tell you the 4 things right now so you think about them, and then we'll come back and we'll finish project evaluation. The first thing is that you need to know that the net present value is the rule you should use, as opposed to things like internal rate of return. So I spend a lot of time going through alternative evaluation methods and conclude that net present value dominates these other methods, even though these other methods could complement the information in the net present value calculation. Second thing is that you have to be really careful about inflation. That if you've got your projected cash flows and you decide to make them in real terms, so constant $1991, and if you discount those cash flows with the usual discount rate, then you're going to make a serious mistake. If your cash flows are real, then your discount rate should also be real. If your cash flows are nominal, your discount rate should be nominal. Don't mix them up. The third thing that happens in capital budgeting is that people ignore the option values within the projects. So that's at the very end of this lecture. So there could be some flexibility options, some options to close the project or begin the project that need to explicitly be calculated within the net present value calculation. That's perhaps one of the more serious mistakes that corporations make, is that they ignore the option value. And the fourth thing we'll talk about next lecture more involved. So we'll leave it right there. Excellent.